Hi, everyone, and welcome to this episode of Ask T3, the real estate industry's podcast where we ask big questions and have guests with really smart answers. I'm your host, Nick Bailey, Chief Real Estate Officer with T360, and we're glad you've joined us, whether it be via LinkedIn, Facebook, or YouTube. And keep in mind, most importantly, be part of our conversation around this. Go to askt3.com at any time. Check out previous episodes, what's coming up, or ask us a question yourself to be part of maybe an upcoming episode or have any questions that we might be able to answer. So today's topic, by the way, the privatization of Fannie and Freddie. You don't hear about it much, but there is an underground conversation happening. And so we want to address what's the state of it, what's the potential impact, what should we be talking about and focusing on, and what's going to happen next. And to do that, we have two really incredible guests today. First, we have Mike Fratantoni. He is the Chief Economist of the Mortgage Bankers Association. Hi, Mike. Thanks for joining us.
Thanks for having me, Nick.
I just want his brain on this subject, and so we're going to get a piece of it. We also have our very own Coby Hakalir. He is the Vice President of Mortgage Banking and Ancillary Services here with T360. Hi, Coby.
Hi, pleased to be here, everybody.
Okay, gents, this conversation is one that's interesting. It's not in the headlines much. I would say most in the real estate industry know what Fannie and Freddie are, but do they really? And this conversation around the privatization, I think, is a pretty in-depth topic. We're going to talk about just a few things that are kind of in a short period of time, but let me start with a little foundation. We've got Fannie and Freddie, two big GSEs, servicers in the mortgage world. I believe one, Mike, keep me true to my history here, was developed in 1938. That would have been Fannie, Freddie in 1970, all designed to help with mortgages, help consumers get mortgages, help them package them, create mortgage products for consumers, help investors with mortgage-backed securities. And we know that there's some recent history that hasn't gone so well for the industry. And so I'll be curious in this conversation, we'll talk about it, if we think this could create any repeats. So with that little touch of background, Mike, start us off. What should we be thinking about, or what is the main conversation happening with the potential of privatization of these GSEs?
Yeah, and I think starting where you did, Nick, of the role of these two enterprises in the mortgage finance market, about half of the home mortgages that are originated get securitized through Fannie Mae and Freddie Mac. About 40% of multifamily mortgages similarly get securitized through Fannie and Freddie Mac. So a very, very large footprint in the U.S. mortgage market. They don't originate mortgages. They buy mortgages from lenders of all types, small, large, bank, non-bank, put them out into investors, a global investor base. There's more than $8 trillion of mortgage-backed securities outstanding. And any investor you could think of puts some of their money in those mortgage-backed securities. Central banks around the world, pension funds, life insurance companies, banks, right? So it is an extraordinarily important part of our overall financial system. And the real sort of benefit of this system is that because it's the securitized market through the capital markets, people have the ability to lock their mortgage rate. There's the widespread availability of 30-year fixed rate mortgages, which just aren't available in other countries around the world. So we really think it's a very much a central building block to the type of mortgage finance system that U.S. Home buyers and homeowners have grown very accustomed to.
And let me also mention, I didn't talk about this. We talked about the privatization. We're going to get into also the detail of how the end output of this conversation could affect consumers and agents and brokers and their businesses. But it went into conservatorship in 2008 during the Great Recession. Most people that have been around this industry for a few years know that it was one that was led by housing because of subprime mortgages, to where essentially the government created the back wall of security. And so this idea of privatization is saying, okay, less government, not the conservatorship. And so kind of what's the overall from your standpoint of why is this on the table even to discuss? If things are secure and it saved us from what happened in 2008, why are we even talking about it?
Yeah. So again, let's go back to their role in the market. They're taking these mortgages, bundling them into securities, selling these securities off to investors, but they're putting their guarantee on the securities that should a borrower default, Fannie and Freddie will cover the difference out to the investor. To your point, in the run-up to the great financial crisis in 2008, they misjudged, and they did not have enough capital to back that guarantee. So they got to the point of becoming almost insolvent. The government came in, the Treasury invested over the couple of years after their conservatorship, almost $200 billion in taxpayer funds to support these companies. That enabled them to keep filling their role, and they've done so. The Treasury Secretary at the time, Hank Paulson, said moving them into conservatorship was a temporary timeout to enable the government to really sort of fix the business models, fix particularly that capital issue where they were insufficiently capitalized for the risk they were taking on. The trouble is that temporary timeout wound up being, we're now 16 plus years later. That's a heck of a timeout if you have any kids, right?
For sure.
That are born and almost off to college now in that time period. So from an industry standpoint, the benefits of moving them out of conservatorship is to get them acting more like private companies again. To your point, Fannie in the 30s, Freddie in the 70s, these were two enterprises operating under congressional charters. So they had specific missions to support U.S. housing policy, but they were also private companies, meaning they were hard driving, they were innovative, they brought a lot of energy and were very responsive to their customers, who are these lenders across the country. What lenders have seen over the 16 years is they lost some of that private sector edge, right? So they're not quite as innovative, not quite as responsive as they had been when they were outside of conservatorship. Let me just make one sort of clarification. So people say conservatorship and privatization. I think these are two separate things. Their regulator, the FHFA, can take them out of conservatorship once they just retain enough capital to sort of get their head above that waterline, right? They're probably a couple of years away from that. Privatization is the fact that I mentioned Treasury invested almost a couple $100 billion into these enterprises. Treasury also has sort of the option to take about 80% of their common stock. So Treasury owns these companies, right? There's government accounting which wouldn't say it that plainly, but they effectively own those companies. And so the privatization part is, how does Treasury back away from that ownership stake, make these companies begin to think of themselves and act more like sort of vigorous private sector entities once again, even though they're still under these congressional charters which guide them to the mission that they're focused on. And then the real trick, how do you do that without disrupting the markets? And to, again, what you said, the focus here is you don't want to do that in a way that leads to more volatile mortgage rates, to higher mortgage rates, to a lack of availability of mortgage credit. Because again, the functions of these enterprises are so critical to the ability of your typical home buyer to get that loan. Someone's only buying a home a couple of times in their life. If the mortgage market's closed on the day they go to buy the home, and there are, the private sector of the mortgage market closes sometimes, but the segment covered by Fannie and Freddie and by FHA, VA, and their securitization, Ginnie Mae, they're always open. That is an enormous benefit to your typical home buyer.
Now I'm going to come back with some of that risk questions, but Coby, let's kind of switch over to you. You obviously know the front lines of this world very, very well. What's happening on the front lines with lenders, with agents, with brokers around the potential of this change? What are you seeing?
Yeah, well, first of all, I think Mike gave a great overview of what we're seeing with Fannie and Freddie, potentially, and the difference between conservatorship and privatization. I think for most real estate agents, they're probably not aware of the ins and outs of Fannie and Freddie and how they impact the market. But I think both of you made the point at some point, but Fannie and Freddie are the backbone of the 30-year fixed mortgage, which is the backbone of our entire housing economy. And it's the envy of the world, right? There's no other, even to the north of us in Canada, which is pretty similar to us in many ways, they don't have a 30-year fixed mortgage. So, that's something that I think has really changed a lot of people's lives in this country, and they don't even know from where it emanated. And so I think that from the front lines of the lender standpoint, lenders want to see innovation. They want to see things progress. They want to see pricing get sharper. They want to see underwriting get more sensible. They want to see, people that are working in the gig economy being able to get mortgages. And I think a lot of people feel that if Fannie and Freddie were privatized or at least taken out of conservatorship and be allowed to be more innovative, that some of those things would happen. Some of the perils that people talk about, for example, the G fee, right? The guarantee fee, going up if Fannie and Freddie to be privatized because of the increase in risk. Well, if we look at the history of it under conservatorship, it's doubled during that conservatorship time. So it hasn't gone down, it's gone the opposite. So I think a lot of those fears are misguided, but I think a lot of the lending industry is very optimistic that this would, just like they're optimistic about the CFPB, being handcuffed a bit. I think they're optimistic about Fannie and Freddie, but of course, just like with the CFPB, what comes next if they are handcuffed, right? Where does that regulation and oversight go to? I think some of those worries and some of those doubts creep in with Fannie and Freddie.
Okay, and I want to mention as well, and then I want to start throwing some of the objections that I see are online and out there as some of the biggest questions answered. But before we do that, I do want to mention something. Here at T360, obviously, we do a lot of research that we put out on a regular basis. And one of them is the annual trends report. And this year in our 2025 trends report, we mentioned that regulation factors were going to start to be a much bigger trend than they have in the past. And so I did want to mention that before we jump into some of these objections or questions that people have, because I want to make sure that all the viewers know that they can go to T3 Trends, get a copy of that trends report that actually spells out our forecast on one of these trends. Okay, gentlemen, let me take you back to this. Answer this for me then. For people that say, prior to conservatorship, isn't that what got us into trouble? Is the fact that there was too much innovation? People weren't qualifying properly for mortgages. Lenders were handing out mortgages that they probably shouldn't have been. It maybe got a little too innovative, and that's what got us in that problem. And do we really want to go back to that? Mike, let's start with you. What do you say when people come at you with maybe that reaction?
Yeah, no, it's a great point. And I think the world has changed quite a bit and for the better. When you look at regulation of the primary market, Coby mentioned the CFPB, which was created out of the Dodd-Frank Act. And there were a whole host of mortgage regulations that were part of the Dodd-Frank Act as well. One specified what's called a qualified mortgage, which basically just puts some guardrails on the types of loans that are going to get preferential regulatory treatment. If you sort of stay right in the middle of the fairway, you don't have quite the same risks as if you go outside of that. Those also changes to the servicing of mortgages. Everything is really being done much more straight and narrow, much more vanilla, and there's some challenges with that. But I think from the primary market perspective, we've never seen sort of credit so solid as we have now. In the secondary market, I mentioned that going into the great financial crisis, Fannie and Freddie really weren't holding enough capital. And you can just think about that. They were putting these guarantees on these securities, and they just didn't have enough to back it up, right? Under their current capital regulation, it's about 10 times higher, literally, than what they had pre-2008. So they got a lot of resources to back up that guarantee. But the other aspect of the pre-2008 Fannie and Freddie was there's this notion of the implicit guarantee, which was Fannie and Freddie would say, well, we're private companies. We got this congressional charter, which no one else has, but we're just private companies. What foreign investors interpreted that to mean was if something really went down, the government would step in and defend them. And they did, obviously, post-2008. So that implicit guarantee wound up being realized as an actual guarantee. We don't think that's a good basis to build any system, right? So even though Fannie and Freddie now have much more capital themselves to back up their guarantee, we think there's a nature of being clear what is the taxpayer on the hook for should things really go south. And so we refer to it as an explicit backstop. And think about it with a bank, there's deposit insurance. The bank can fail, but that depositor is protected. In the same way here, the mortgages may go into default. Fannie and Freddie may fail again, but that investor in their security is going to be protected by this backstop. In the same way a bank pays a premium for that deposit insurance, we would think Fannie and Freddie would pay a premium for this basically insurance on their securities. Behind their own capital, you'd have a government backstop. We've spent much of the 16 years post-conservatorship trying to figure out how to do that. It's sort of the last unsolved piece. To my point of this, and Treasury Secretary Besson's been really clear about this when asked about should they exit conservatorship, should Treasury exit their stake, his sort of metric of success is what happens to mortgage rates, right? If we do this right, you're reassuring global investors, you're reassuring lenders, you're reassuring the capital markets generally that these entities are safe. There's a backstop in place should something happen beyond their ability to cover those guarantees, and we can keep providing mortgages in a safe, sound, steady fashion to benefit home buyers and homeowners.
And I think that's a great point there. And I want to come back to rates and costs here in a moment. Coby, from your side, what do you hear about people that say, hey, I thought we fixed it. Is it really broken? Similar question, but a little bit more of, is this on people's minds of why are we even discussing this?
Yeah, and that's a great question. I want to address things that both of you said previously. But one of the problems that we have with the perception of the real estate market is we have a constant onslaught by the mainstream media on the housing market. Just yesterday there was a report from Fitch talking about the overvaluation of the housing market. Well, what does that mean, right? And so we have fears constantly being stoked for the public as to what the housing market may mean, and that keeps a lot of people on the sidelines, aside from the lack of inventory and high interest rates and all the other issues. But something you said, about did we have too much innovation, Nick? Right? I don't think we had too much innovation. I think we had too much greed. And I think that's what led to a lot of the problems that came about back then. And the difference between 2009 and 2025 is something that Mike touched on, right? In 2009, you had about 6 trillion in home equity versus about 12 trillion in consumer debt. And now that number is about 35 trillion in home equity versus 17 trillion in consumer debt. And so we're in a much healthier spot right now. And this is really a time to be thinking about, all right, how do we move things forward? How do we move things forward for our housing market? Because we do need some innovative solutions from the mortgage side, from the real estate side, from the legislative side to really unlock things. And it's going to take a heck of a lot more than converting shopping malls into condominiums.
Just saw a huge high rise. I'm here in Denver. That's like valued at 200 million, sold yesterday or earlier this week for $3.5 million, converted to 700 apartments. Like, wow. We forecasted that a few years ago. But anyway, okay, Mike, I want to tap into your Economist side. Of course, you've given us information on the nuts and bolts of this subject, but how does this change, or maybe no change, maybe both sides of it? What kind of economic impact could this have?
Yeah. Well, this is one of those challenges as a business person, and I think all your viewers here can understand it, right? If you have this decision where if you move forward and everything goes exactly right, and the aim is you wind up about where you are in terms of the level of housing market activity and mortgage rates, et cetera, and the downside looks pretty bad relative to that. That's a risky bet, and that's what's kept people so cautious. And those, by people I mean Treasury secretaries, various Congress folks through the years who have just said, this is a tough move to make. Can we sort of inch towards it again, as opposed to a big bang change, just because we're talking about 8 trillion plus, right, of mortgage-backed securities out there. We don't want to do this wrong. Because again, we've seen in parts of the market, when the jumbo market freezes up, that means for a time, literally people cannot get a jumbo loan, right? Or various other aspects in the private market. Maybe it gets really, really difficult to get a loan for an investor property or for a second home, right? And so when you're thinking about that core of the market, your conforming balance borrower buying a home in middle America, and they have W-2 income, totally agree that things like gig economy, all those things we want to be more responsive to, but sort of keeping eyes on the prize, right? Like, we always have to be able to serve your typical customer that comes in the door.
That makes sense. And speaking of price, Coby, let's talk affordability. We all know that that's a major subject people are talking about, especially first-time home buyers. The amount of price appreciation in the last few years has obviously been very high. And so what do you think this type of impact to a change when some say costs are just going to go up? The environment may not be as competitive and it's just going to price people out of the market. Is that a valid response to this? Is it the opposite, or what's your position on it?
Well, I think that's why, I'm with Mike on this, that, I'm not a rush to privatization advocate. I'm a rush to let's have the conversation advocate, because I think it's something we should be talking about. We need to be figuring out, how to move our housing industry forward. It's a very real risk that, in increased G fees because of an increased perceived risk from a private company or privately held Fannie or Freddie will increase the cost of buying a home. And we know that for every 0.25% interest rate, it takes another, I think, million buyers out of the home market, right? If I'm correct on that number, I think I am. And so we have to be very careful with that, especially when we're already on the precipice of so many people not being able to afford a home. I think that, we have to, before we get into the privatization, we have to understand what all the risks are, but we have to clearly define what the positives might be. And I don't think we've gotten there yet, right? We know what a lot of the risks are in terms of affordability. We know what they are in terms of the rural borrowers being phased out because the margins on them are not good. We know what it means to minority and first-time home buyers, but we don't yet know what the upside is. And until we have a clear vision of the upside, we can't really do anything. And that's why we need that conversation.
I love that point, because I think it's just it's just human nature. We don't talk about the upside. We always start with how does it impact negatively status quo of what we know that's happening today. And I think that's what we're going to see more of in the headlines, is why this is a negative. Okay, Mike, I don't mean to put you on the spot, but probably going to a little bit here. You're a voice of the Mortgage Bankers Association. Your constituency probably has vast opinions all over the place on this. But does the MBA have an overall position on this subject and where it goes?
Yeah, we do think, and again, I like the way Coby said it, we don't think they should exit conservatorship tomorrow, but we think it would be really helpful for this FHFA, this Treasury Secretary, to, in the near future, next year or two, lay out a plan. Here's our thinking of how they're going to continue to raise capital to get to the point where it becomes sort of a live question, how Treasury is thinking about their stake in the enterprises, what we've learned over this past 16 years. So, again, I talked about the need for an explicit backstop. There's different ways of getting there. Don't need to dive into the weeds there. Something that's really, really important to our members, and our members range from, small family-owned companies to the largest banks in the country, right? And business models all across the board. They all see value in Fannie and Freddie performing their role, but some might want a little different things from them, right? One thing that we've been really focused on is, before the great financial crisis, some of those biggest lenders got a real deal from Fannie and Freddie in terms of the guarantee fees they paid, and that really gave them a huge advantage out in the marketplace. We said, Fannie and Freddie, you got to give the same price to everyone, right? The pricing should be reflective of the risk in the loan, not the size of the lender who's bringing the loan to you. And we've been successful in getting, bipartisan consensus. That's a good way of doing it, because, to your point, that means whether you're in a rural area, an urban area, north, south, east, west, all lenders are going to be out there able to help in providing, really, really competitive rates to all their customers. So that's an example of the kind of thing that all our members agree on. Not all our members agree on what should the footprint of Fannie and Freddie look like, right? Over the past 10 years, you've seen them be in and out of the investor home market, the second home market to a greater or lesser extent. There's been debates about how quickly should that conforming loan limit increase, right? So what does that jumbo market look like versus what does the conforming market look like? And different members have different views on that, right? So that's an example of some of the within the family debates we have, right? But I talked about when we're talking to Congress and the administration, there's a lot that our membership fully agrees on.
Okay, good. I think this is going to be hotly debated conversation in the months to come and years to come for sure. It's no easy subject, but let me ask you kind of a final question for both of you, just very quickly to round us out. Scale of 1 to 10, 10 being an absolute 100% yes. Is privatization of this going to happen in the next few years? Coby, start with you.
I think we're at about a 7 or 8 right now, based on what we're seeing from Pulte and the FHFA moves that he's making, based on what the administration is signaling. It seems like it's getting close to a fait accompli. I don't know if it's quite there yet, but it's I put my money on it versus not.
Mike, how about you?
So I'm going to agree with Coby at 7 or 8 in terms of them presenting a plan, within the next year or two. But my guess would be that plan lays out a 5 or longer year process for actually implementing that plan. And in terms of market impact for what your viewers are going to be potentially feeling, just the release of that plan could have an impact if it gets people to think differently about these enterprises and their mortgage-backed securities. But the full sort of bore impact of that is going to be as that plan is rolled out and implemented over time. So totally, I think it's likely it's going to be a discussion point more next year than this year. But if it's done carefully, which again, this Treasury Secretary, this FHA has gone to great pains to say they're going to do it carefully, the plan shouldn't create much waves in the market. And so then it's just going to be a long implementation to make sure it's done smoothly without disruption.
Excellent points. Gentlemen, 2 of the smartest minds in this mortgage world. Thank you both.
Thank you.
Thank you, Nick.
All right, this is an example of Ask T3. This is a subject that is a big, huge question. And thanks to our guests today for some pretty smart answers. It's interesting when I think about Fannie and Freddie and my nearly 3 decades in this industry, it's one that I always knew existed, but wasn't one that was talked about often because of the lack of overall impact to say an agent or a buyer that people could directly feel. This could be the time that we feel it more than ever. So we'll keep the conversation going. Thanks for joining us. And again, be part of this conversation. Visit us at askt3.com. Check out next episodes, past episodes, and offer any questions that you would like. So thanks for joining us. We'll see you next time.